Namaskar, this is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. India's banking system remains rife with bad loans, popularly known as NPAs. These loans go bad due to various reasons, which include banker negligence, which includes banker incompetence and banker corruption by way of loan for bribes at times, and also because of unforeseen losses which are incurred by borrowers because of genuine reasons beyond their control. It is not just because of malified reasons that loans go bad. It also happens for bona fide reasons, particularly in cyclical industries and in new and unproven businesses where contingencies do occur, projections go bad, losses are incurred, and defaults take place. Loans also go bad due to borrower frauds, and these frauds often have a banker as an accomplice to facilitate them, particularly when it is a big size loan which has been given to a borrower. A bank loan is not written off or taken to court as soon as a default occurs as a general rule. At the first instance, when a payment default occurs, efforts are made to rescue the account, failing which efforts are made to amicably recover the loan without resorting to coercive recovery. Such amicable mutual settlement of a loan account includes a one-time settlement or an OTS, which may entail a haircut to the bank, meaning that it writes off a part of the loan and it recovers the balance amount only. The terms of settlement and the amount of haircut all depend on how secured the bank is. The more the security with the bank, the lesser is the haircut that it is willing to give. Only if the amicable means to settle or resolve a debt, default or recovery fail that the matter goes to the courts for recovery, whether it be the DRT or it be the NCLT. When any case for the recovery of a bank loan reaches the NCLT, the options before it to resolve the case in a time-bound manner range from selling the assets to repay the loans to selling the company itself and getting in a new management which in turn will repay the loans, to settlement under a one-time settlement under an OTS, or to finally liquidate the company if everything else fails. However, in the case of a fraud or a willful default, while the recovery proceedings go on at the NCLT, a parallel investigation is simultaneously initiated by the criminal investigation agencies like the CBI, like the Enforcement Directorate and the EOW in order to prosecute and punish the fraudulent borrowers. While the NCLT is considered to be the apex and the most effective forum for the banks to recover their bad loans, the irony is that the ratio of recovery at this highest forum tends to be the lowest at times. The past data shows that on an average, a mere fraction of the loans is recovered at the NCLT, apart from the massive delays that take place despite the NCLT being mandated by the IBC to resolve such cases in a time-bound manner. The delays at the NCLT cause the charged security to deteriorate further, which only depletes the ultimate recovery of the bank loans. The fact, however, is that what can the NCLT do if the security against the loans available with the lenders is itself poor? Most cases of loan recovery which ultimately reach the NCLT have been found to have little security in reality, where the working capital assets like stocks and book debts which have been hypothecated to the banks are simply siphoned away and gone, and so is the case with fixed assets very often. What the NCLT deals with is what comes to it on as is where is basis, and it can do little to improve it if no security, if no assets were available with the bankers. For example, in the case of Alok Industries, almost 20,000 crore of stocks and receivables hypothecated to the banks were just not there. They had simply vanished, leading to an 83% haircut to the banks in the settlements at the NCLT. That's the kind of money they had to write off when it came to settling the loan of the Alok Industries case. The blame for such haircuts lies on the banks only and not on the NCLT, which is merely officiating over the settlement or liquidation rights and rituals, as the case may be. While one may expect the NCLT to help in improving the recovery of loans by banks, the fact, however, is that where the bankers themselves in the committee of creditors, which is the COC, agree to a paltry settlement of the loan, which thus results in a pathetic recovery, the NCLT can do very little to improve it. The reality is that the way the IBC code is drafted, the NCLT, which is supposed to be the final approving authority for the settlement of the bank loans by way of a one-time settlement under the IBC, has no choice but to approve any settlement of an NPA account which has been consented to by the COC, which consists of the lenders, and that consent has come with an over 90% majority of the COC members, even if it means that most of the loan is written off under the terms of settlement, as we have shockingly seen in cases like Alok Industries, Arcom, Videocon and Siva Industries. The NCLT is a mere mute spectator under the IBC, and it has no choice but to toe the line and to approve the settlement of the loans agreed upon by the lenders, even if such settlement involves a massive write-off of the bank loans. That truly makes the NCLT order approving the settlement of the loan to be an empty formality according to us. If the NCLT has any objection to the terms of settlement, then those get overruled by the higher courts, which say that the NCLT has no right to object against what has been approved by the Committee of Creditors, as we have seen in the latest case of Siva Industries. In the case of Siva Industries, the banks agreed to a 93% haircut. That's the kind of amount they wrote off, and they settled their loans of almost 5,000 crore rupees with a recovery of a mere 328 crore rupees, that too not payable instantly, but within 6 months of approval of the settlement. Approval by the NCLT. Within 6 months of that is when they were to pay it. There was no prepayment, there was no advance payment. This proposal was shockingly approved by the company's COC with an over 94% majority. The NCLT rejected such a settlement which had a 93% write-off of the loans, and it ordered a liquidation of the company as the right thing to do. The NCLT approved the NCLT order, and it confirmed that Siva Industries must be liquidated and no such settlement will take place. The Supreme Court, however, in an order passed in March this year, stayed the NCLT order, and it has now passed an order rejecting the order passed by the NCLT. In other words, it said that the company will not be liquidated and that the settlement which has been approved by the COC will have to be accepted. The Supreme Court thus allowed the banks to proceed with the offer of settlement which was submitted by the promoter of Siva Industries, since it had been approved by 90% of the Committee of Creditors. The top court held that such a settlement was legitimate and valid, and it stated that, the first thing it stated was that there is an intrinsic assumption that the financial creditors of the company are fully informed about the viability of the corporate debtor, which is the borrower, and that of the feasibility of the proposed resolution plan. According to it, they act on the basis of a thorough examination of the proposed resolution plan and the assessment of it made by their team of experts. The Supreme Court then said that when 90% or more of the creditors have found it to be in the interest of the stakeholders to permit a settlement and to withdraw the bankruptcy proceedings, then it said that the higher courts cannot sit in appeal on this. What has been decided by the creditors will be binding and final. It then further said that the commercial wisdom of the COC should not face judicial intervention, and that neither the NCLT nor the NCLT were justified in giving due consideration to the commercial wisdom of the COC, under which terms of settlement were finalized and agreed upon. And it finally said that interference is warranted only if the NCLT or the NCLT find the decision of the COC to be wholly capricious, arbitrary, irrational, and beyond the provisions of the statute or the rules. A similar case is pending before the Supreme Court in the case of Videocon, where the Committee of Creditors agreed to settle the total outstanding debt and loans of the group companies of over 70,000 crores for a mere 2,962 crores, entailing a haircut of about 96%. This amount was also not payable immediately, but it was to be paid over a period of 6 years after such a settlement was approved. This outlandish offer to settle the dues of Videocon was strangely accepted by the Committee of Creditors. While the NCLT found major lapses in the approval by the COC, it yet consented to the terms of settlement, saying that it had no choice but to agree to do so. In appeal, the NCLT, however, found the offer to be too low and it rejected the settlement at a paltry figure of 2,962 crores, and it ordered that fresh bids must be called for. The winning bidder, which happens to be a Vedanta Group company, has filed an appeal before the Supreme Court challenging the NCLT order, and now with this order of the Supreme Court in the case of Siva Industries, it is bound to succeed. In other words, what has been decided by the Committee of Creditors in the case of Videocon will also prevail. While these Supreme Court orders lay to rest a controversy, there to us are far more serious issues that arise because of it. The first one, in the matter of settlement of loans at a haircut, the bankers who are the members of the COC and who approve the terms of settlement, according to us, are interested parties of sorts. It is they who gave the loans that went bad, and it is now they who are settling and closing the case on terms that they deem fit, thus giving them a chance to protect their negligent and corrupt colleagues at times. The second issue, liquidation of a company is a long process, and it involves investigation of the company's affairs before it is liquidated to ensure and check accountability. A settlement of the loan in a case like Videocon or Siva Industries, etc., prevents any such investigation, and it protects the delinquents, which is not the right thing to do. The third issue, a stringent code of conduct is needed to regulate the decision of the COC to ensure that they are judicious, they are fair, they are legitimate, and they are not trying to protect or they don't have a vested interest. And finally, it provides a direct opportunity to scammy promoters to settle their bank loans at heavy discounts, making a killing and then continuing to own the very company where they defaulted the bankers. If settlement with haircuts of over 90% are not found to be arbitrary and irrational, then which ones will be so found that judicial intervention will be needed and will be called for, is the question to be asked. Which are the cases where you would say that it is arbitrary? If over 95% of a loan is being written off, it means that liquidation is a better option. But then, as the Apex Court says, and with due respect to it, if the Committee of Creditors decides otherwise, then it will be final. We think that there are larger issues at stake and they need to be looked into. This is Akhilesh Bhargava signing off till we meet again. Namaskar.